Okay, folks, welcome to Thursday Night Stock Charts Live. This is Bob Desmond, and what we're going to talk about today is the economy. A lot of charts about the economy. We're going to do a timeline of what I think is going on here in terms of the expectations for rate cuts relative to the inflation reports that have been coming out of late. We'll talk about the weekly charts of the major averages. We're going to talk about natural gas. Yes, boring natural gas. I'm going to shock you with a statistic about natural gas. So let's get to it. Let's talk about, first, let's get valuations out of the way. And you know what? Let's get a couple of comments out of the way first. Say hello to folks. Jody, welcome. The lovely Jody. Okay, let's talk about valuations of the market. At current, we remain about on par with where we were on Sunday night. Very, very expensive on a relative basis. So we are now the second highest in terms of PE multiple since the 2000 financial crisis. Sean, welcome. George, welcome. Our good friend from Quebec from the north. I want to get up there soon, maybe this winter, and I want to experience that Quebec French feel. I hear it's beautiful up there. I used to, when I was a kid, one of my favorite subjects was history, and I studied the French and Indian War and the siege of Quebec. That's how I know so much about that town. Not that I've ever been there. I'm ashamed to say I've never even been to Canada, and I live in New York. But I did fish in Pulaski, and I could see Canada when I was fishing for salmon in Pulaski. I digress. Okay. I'm waiting for people to come in. All right. More people filling in here. All right. So let's talk a little bit about the economic data that came out this week. That came out this week. Forget about Monday, Tuesday, NFIB, small business optimism. Optimism picked up. New administration, people are feeling good. Productivity, good. Unit labor costs, less than what was expected. Bullish. Wednesday, CPI. I got to be honest with you. This one threw me. I saw the year-over-year number come out, and I says to myself, the markets have to go down on this. Surely the Fed Watch tool is going to reduce the level of anticipated rate cuts coming in December, January, February, etc. It didn't. Even though the year-over-year CPI rose on the headline number. So year-over-year headline CPI rose year over year. Yet the Federal Reserve is cutting rates. More on that in a moment. Then today, we get PPI, the Producer Price Index. That came in twice as hot as what was expected. At the core, less worse. The year-over-year number on the headline came out higher as well. I'm not seeing that here. Oh, here it is, right here. Maybe I got to put my glasses back on. So, yeah, we came in 4 bips. Think about that. 4 bips higher than the prior year. The Federal Reserve is cutting rates. And we're going to talk more about the insanity in a moment. So, just some of the headlines that came out. Inflation heads in the wrong direction. CPI shows the Fed still on track to cut rates. Yes. Muted wholesale inflation rate likely gives final go-ahead. I don't know how this is muted. How is this muted? We came in twice as hot as expected and higher by 4 basis points year over year. I don't know how they get how do they get to this? How do you go from the results, the numbers? Oh, they're going by the core. They're going by the core, X food and energy. No, we pay what's at the headline number. We don't get spared food and energy. We pay for food and energy, which eventually is going to get passed along to the consumer. Right now, it's isolated amongst the producers. The problem is if they don't pass that along to the consumer and hope that the consumer will buy the product at a higher price, guess what happens if they don't pass that along? This just artificially became higher overnight, even though stocks were down. Why? It's because they can't pass along their costs. What does that impact? It impacts their earnings moving forward. Now, we take a look at the charts of the PPI. Maybe we're missing something. Maybe something is off here. Here's the producer price index, all in. 5-year view, we're beginning to creep up higher. Not horrifically, but I'll tell you, were this a stock chart, I'd be taking my crayon out, drawing a trend line and saying, you know what? Guess what? We have a higher low. We have a higher low, and now I'm looking for a breakout on PPI above the July of 2024 highs. If we get that, I don't want to be long of stocks. And if the Federal Reserve insists upon cutting rates into that, I want to own anything, gold, oil, anything that you could drop on your foot and it hurts. I want to own that. I want commodities. And we'll talk more about commodities in a moment. I want commodities. Not right now. Not right now. The market's giving us a head fake because yields went up today. Here's the CPI. We're at all-time highs. Consumer price index for all urban consumers, all items in U.S. city average. And the Federal Reserve is cutting rates. GDP. GDP continues to climb up higher. No end in sight yet. The Federal Reserve is cutting rates. We continue. So we're getting real GDP that's at all-time highs, assuming that these are real numbers. We won't know until the new administration is in. Then we get the revisions. But manufacturing peaked out back here in November of 2023. What's driving this? It's this. It's government spending. This is just, is this just the I want to make sure I have the right chart up here. Gross domestic product. Yeah, this is all in, including interest payments. This is what is driving this right now. Granted, services are very strong as well. They're in expansion mode, but you got to have your manufacturing. You got to produce stuff to have a vibrant, real GDP. But when you're driving up a GDP due to the fact that you have government spending that's gone through a roof, that's a problem. It creates its own problems. And what is the problem? Well, you saw it today on PPI. You saw it yesterday on CPI. It's called the velocity of money. Basically, the velocity of money is the number of transactions, the number of times a single dollar bill will transact. Now, if people are afraid to spend money, then M2, you can print all the money in the world. If people don't spend it, you're not going to get inflation. There needs to be demand. But you're seeing demand ever since 2020, COVID, and the demand is really not stopped. The rate of change has quieted down a little bit, and that's given us a brief respite from inflation, but clearly the trend is up. So with all this news that we have inflation out there, what was the expectation change by market participants? What did they expect? Well, I'll be honest with you. When I heard the news, I heard the PPI. I didn't hear the jobless numbers first. Excuse me, the initial jobless claims, which come out each week. We'll go to that in a moment. The probability of an ease remained in the mid to high 90s. So this morning when I woke up, this was at 98%. It only dropped back down 4 percentage points. So they're going to go in December. This is the last of the major economic data. January. This hardly budged since this morning. So I don't want to go out much further than January, March, almost a surefire guarantee, but that's way off right now. Let's just go as far out as January. Right now, they're pricing in a high probability of a rate cut, even though we have PPI moving up higher, CPI ripping, GDP all-time highs. And I think I know the reason why. The why is this is just a clue. Initial jobless claims. Jobless claims jumped to 2-month high in a cautionary sign, but holidays may be to blame. I don't know. This is usually seasonally adjusted, so I don't know why they're rationalizing here. Let's move on. Forget the rationalization. Let's take a look at the trend. The trend is what matters. Forget about the headlines. Here is the 4-week average of initial jobless claims. Clearly, we are moving up. And I've spoken about the jobless claims in the past and how they play games with the what you call the U3 number versus the U6 number out of the Bureau of Labor and Statistics. So the U6 came into being in 1994. Prior to that, the U6 unemployment rate here was your headline number. When they came out with inflation data each month, pardon me, when they came out with non-farm payrolls each month, or the unemployment rate each month, they would use the U6 number, which is measurably higher. Way too many charts up here. But then in 1994, they began with the U3 number. The U3 number is often criticized for being too simple. Many economists believe it fails to take the whole picture into account. You think? Because it excludes only people who are actively seeking employment. Think about that one. How convenient for the federal government that once you have stopped looking for a job, you are no longer counted in, and all of a sudden the jobless picture looks better than in reality. So the U6 number is here. Unlike the U3 rate, the U6 unemployment rate includes a whole swath of unemployed people. It is seen by many as more in line with what means to be unemployed. This rate accounts for anyone who is seeking employment, who has been unable to secure a job and has not searched for work in the past 4 weeks. Those people are not included in the U3 number. They've gone back to school, yet they're still counted in. The unemployment rate has become disabled. They're counted in. Is underemployed or working part-time. They can't find enough work to make ends meet. So you take a look. I touched upon this already. Here are initial jobless claims. We get this each week, the 4-week moving average ticking up higher. Now you go to the U3 number. Here, oop, what happened? This is what I want. Bingo. Unemployment rate, the U3 number, we have a very benign 4.2% unemployment rate. That's technically fully employed, as the government likes to say. There's a problem. It's going up. And while still at historically low levels, the trend, the base is built. Now we're putting in higher lows and higher highs. Again, were this a stock, and somebody asked me on stock chart request, is this a buy? I would have to say, yeah, it stopped going down. We've begun to put in higher lows and higher highs. It's time to start building a position. The problem is that you're buying unemployment, which is not good. Then you take a look at the U6 data. Remember, this is an all-in view of the real unemployment rate. What's the real unemployment rate in the United States? 7.8%, not 4.2%. 7.8%, 5-year view. We've stopped going down, and we are now inching up higher. Now, you take a look at the job openings that are out there. Job openings have ticked up of late, but we can't go by 1 or 2 reports because they get revised. You want to pay attention to the trend. And if I had a crayon in front of me, I would draw the trend line. Are we putting in lower highs and lower lows? The trend is clear. It's defined. No noise here. So job openings are declining. They are in a bear market. So what are, if you were a business owner, and many of you are business owners, or if you work for a corporation and you're a manager, and you're planning for your next fiscal year, are you going to, if you're worried about the business, what are you going to do first? Are you going to lay people off? Probably not. You invested a lot of time in hiring them. Good employees are hard to come by. You've invested in their training. They're reliable. You know what? I'm not going to do that, but I'm not going to put up that new job posting I wanted to. I'll offer Johnny or Joni more overtime so they can make the money rather than bringing on a newbie that I'll have a nightmare trying to fire if he doesn't work out. So the first thing that they'll do is they'll take down the job postings. That goes first. Job openings evaporate. Then average hours worked move up higher, as does the overtime increase. So government doesn't care. They're good. They're getting paid their taxes on overtime. Time and a half, lovely. They don't complain. But the Federal Reserve knows this is out here. They also know that we've been living through a corrupt regime over the past 4 years. Not that they're not all corrupt, including every president probably in history. But this one in particular was a particularly nefarious one. So Lord knows, when you go back to GDP, what's the real GDP? When you go back to the unemployment rate, what's the real unemployment? Remember, only a few months ago, they came out and they revised down by over 800,000 jobs. The prior year's quoted new job creation. The job claims that we get every month, They revised them down by 800,000. And each one of the times that we beat on those reports, the stock market went up. Now that you have job openings declining, unemployment moving up higher, whether it be on the U3 or the U6, the stock market is at all-time highs. And not just at all-time highs. It's the second most expensive in history. On a PE basis, price to sales, price to books, you name it, it's very expensive. So why is the Federal Reserve still going to cut rates? They know what's coming. They could sniff it out. This is also known as the JOLTS report, is an indicator of what is coming. This is influencing this now, the unemployment rate. So the problem for the Federal Reserve is that they're cutting rates, yet the long end of the spectrum, meaning the 10-year yield, is going up. Here's the weekly chart. We're at the highs of the week. Let's take a look at what we did on the day. This is not what the Federal Reserve wants. This is not what they want. They want yields to go down. The bond market is saying, no, you guys are out of your mind. If you think that we're going to lend you more money when you're spending like drunken sailors, you plan on spending more, yet you're lowering interest rates into a rising inflationary picture. What is wrong with you? So it's a matter, in the case of the Federal Reserve, of playing 4D chess. So where to from here? Yield curve. Now, the yield curve broke out last week. We're at the highs of the week at current. And for those folks that are wondering, what does this really mean here? And what the yield curve tells you is that there's a normalization of a sense where you're getting the shorter duration bonds that are paying less than longer duration bonds. That's exactly what's happening right now. And you're seeing that. Today, you had short-term bond yields that went up, but longer-term bond yields went up higher. So the yield curve is uninverting. It is steepening. It's already uninverted. So how does the Federal Reserve address this? Well, they need to stop doing what they've been doing since around spring of 2022, when they began rolling off debt. This is the Federal Reserve's balance sheet. After the COVID crisis, they expanded the balance sheet, printed money, quantitative easing, printed money hand over fist. What did that get us? Money supply ripping through the ceiling. That was M1. This is M2, money supply ripping through the ceiling and re-accelerating. So they've been very steadfast in lowering the amount of debt off of their balance sheet. And when you take a look at this on a weekly time frame, you could see that the rate of change with the amount of debt that they're rolling off their balance sheet has come to a halt. I think it dropped measurably last week, only by $2 billion. That's nothing. Nothing. So you can see the rate of change ever since we dropped down below 7 trillion has been benign. So to get the 10-year yield to drop back down, you need the Federal Reserve to begin buying debt. In essence, reversing course and lifting this balance sheet up higher. And when they do, have little doubt, the stock market's going to fly. It's going to rip. So that, my friends, is what's going on in the markets right now. It's a game of 4D chess, and I don't think that the stock market has figured out yet what the bond market already knows, is that we're going to need to feel pain so that the Federal Reserve has an excuse. They can't just have a meeting and say, okay, we're going to start buying debt. They're going to need a reason, and that reason is going to have to be pain. And what's going to bring the pain to the markets is rising yields on the long end, and that's going to drive the yield curve up higher, thus creating a crisis, which remember, they've already claimed victory. They've already claimed victory. Now they're in rate cut mode. That last crisis is gone. The one they created, that's over with. They fixed it. They stated it. Here's the funny part. They stated that success a number of years ago was going to be a return to 2%. Remember that? A return to 2% inflation. We never got there. Inflation is going up, yet they've claimed victory and they're cutting rates. Can't make it up. You can't make it up. So where do we want to be as the yield curve now begins to flash a major, major reversal bar and threatens to take out the prior month's highs and enter this gray zone, which ought to be shaded red? In fact, I may just change this to red at some point in time in the future, because this is when things get wonky. Once we begin to trade up and into this range, because that's when the steepening accelerates. And then you look at the S&P 500, when you get the steepening of the yield curve, the S&P 500 rolls over. S&P 500 here in gray. But where do you want to put your money? That's the question. That's why we're all here. We want to make money. How do we make money? Could buy gold? Not yet. It's not time yet. It's not time yet. Patience, patience, patience. Believe it or not, natural gas. Nobody, you're gonna hear that only here. Only here are you gonna hear that. Natural gas, highly uncorrelated to the S&P 500 equities in general. And if I were to hazard you a guess of what was one of the best performing investments for the past quarter, what would you guess? I bet you the last thing on your mind is going to be natural gas. Natural gas is up, and this is not a leveraged product. This is the continuous contract, up 18.2%. Natty gas. So we talk about it quite a bit. We treat it as well. We sold some covered calls today on Boyle, which is a leveraged product. That is up, excuse me. That is up on the quarter. Oh, they did a reverse split. Sorry. It's up 3 times. Well, probably not as much as 3 times as a continuous contract, because I'm sure UNG times 2. I don't know why UNG is showing down, but the continuous contract is showing up. Interesting. Anyway, the futures are paying off. So natural gas behaving very, very well here. And we sold covered calls today going out and into January on Boyle and got some decent premium. So nat gas looking very, very good. And one thing that you really want to appreciate here is that when you do a ratio chart of, let's say, you know what? No, let's not do that. Let's do this. Let's do this. A ratio chart of, or a correlation chart of natural gas versus the S&P 500. They've been pretty tightly correlated this quarter, but over history, they're very uncorrelated. See, over the course of, this is a monthly chart, they have very little in terms of correlation. They just both happen to be moving up at current. So this is kind of a safe haven play if and when that yield curve begins to move up. And the other factor behind natural gas at current is that you have data center demand. Now, the reason why we sold, this is TrendSpider, 35% discount code below if you want this functionality, seasonality. The reason why I sold covered calls here on Boyle natural gas is that we're in a seasonally unfavorable period of time. So it's good to have a hedge on the position. That being said, I love the fact that, at least on the UNG here, which is not reflective of the true price, we have just been consolidating and we are building a base. We have stopped going down. So this is very, very bullish to me. The data center demand for AI, I posted a chart in the Bull and Bear Forum today, this morning, early this morning. Here. Exxon plans large nat gas plants to supply electricity for data centers. So the money is flowing into natural gas infrastructure. It's where you want to be. The bear market in natural gas is over. So it's time to begin accumulating a position, which we have. We'll add more to it once we begin to see some bullish price action and we head into a seasonally favorable period of time. But right now, it's a good time. If you don't have any, nibble, nibble, nibble. Add, build a position, sell some calls, good premiums. Let's talk about let's go to comments. Yeah, I can't wait to get up there. I really can't. I love French food, man. I liked French food before I went to Paris, but when I went to Paris, Paris is such a great town. So I really want to get up to, it's like, I hear it's like Europe, but in Canada. TZ Burton, welcome. We are fighting to keep our natural gas in Washington State. We passed an initiative, but environmentalists are suing. Okay, doesn't shock me. Bob, go visit old Quebec City. It's beautiful. Okay. Hey, Bob and fellow contrarians, Talon, welcome. Everybody loves Talon. Superstar. Thinking of going risk off right before Inauguration Day. Makes sense. It makes sense. Agreed. It's even the some of the greenies are warming up, pardon the pun, to natural gas. Let's talk about the weekly charts. All right. So with the rise in inflation, the CRB commodity index is now beginning to break out. So prices are moving up. This is not going to be good for the equity markets, especially with the Federal Reserve cutting rates. It's incredible. It's incredible. So the fact that the Federal Reserve is cutting rates into an inflationary environment, bonds are getting crushed. They're absolutely getting crushed. Now, I have a bond position. Yeah, this is not good. Not good. So if we begin to break the new lower lows, we're going to have to stop out and move into something else. Short-term bond fund, something like that. But this is not working. Not working at all. And this is the globe. This is the world saying we don't want your debt. We don't want your debt. You guys are crazy. We want to get paid more for your debt because yields are moving up higher. We already went over this. Treasury inflation protected securities. You would think that they were moving up higher. They're not. Why? Because interest rates are going up on the long end. The dollar, very strong price action. This is why you don't want to buy emerging markets. You don't want to buy gold stocks. None of that. Mining, avoid it right now. Euro, getting destroyed. They did something again overnight. I forget what it was. It was so early this morning. I read it. Yen, rolling over. Bitcoin. I still think that this is a good chance that they pump a lot of money into this and pump it up higher. They broke it out today, but they failed to get it to close there. I think they're breaking this out higher. Volatility. An up week. And we knew this was coming. How do we know? They say you can't chart the VIX. Yeah, you can. Descending wedge formation. We broke out. We got a pull back, and then we got a follow through on Tuesday, right? Thursday? Yeah, today's Thursday, not Friday. So VIX looks like it wants to go up higher. The Dow transports. New weekly lower lows on volume. Dow Jones Industrial Average. New weekly lower lows, down 1.63% on volume. S&P 500. Weekly view. An inside week. No new high, no new low. Not looking good. Let's go daily view here. I can't be overly bearish here because there's not a lot of volume. And we need to remember that here's a seasonality view. It's a strong month, right? And we know that from a weekly view, we know these 2 weeks here are a bit iffy. We know there's volatility out there, But we also know that the final week of the year is up 68% of the time. Then at the beginning, first 2 weeks of the year, it's somewhat favorable. Why? Fund managers who sold their losers or had money on the sidelines at the end of the year, the ones who sold their losers for tax loss selling, they buy them back, ideally at lower prices, and they get the tax benefit as well. And other fund managers are out there, they have money they have to put to work for the new year, so they buy stocks. But then things become a little bit more wonky as you get mid-January. So this is the time frame that we're in. It's a seasonally favorable period of time. 2 weeks right now, next week, this week, a bit of chop. And that's what we're seeing. It's playing out perfectly. Qs, weekly chart. Very thin up volume. We're flat on the session. Let's go daily view. And inside week. We have a short position here, and I spoke about this earlier today, that I didn't want to add to it. I just don't want to add to it. What happens here this time of year, and I've mentioned this to members, and they're probably sick of me saying it, but I repeat myself because many times we have new traders. We have my service has traders who are very experienced and traders who are new. So the new folks, they need to hear things over and over again until yeah, I get that. I understand. Now I understand. Okay. So this time of year, it's already begun. Look at the volume on a daily chart here on the Qs. Volume is dropping off, except for yesterday, which is pretty good, but that was a one-off. Volume is trending down. And that's what we'd expect during a seasonally slow period of time. And each day that we get closer to Hanukkah, Christmas, New Year's, then the computers are put on autopilot and everybody flies off to Stad and Aspen and wherever the hell else they go, and they go on vacation. They don't allow crash to happen unless it's a geopolitical event. It's not going to happen. So what are you going to do? You're going to short into a computer on low volume? Doesn't make sense. Small caps annihilated this week, down nearly 5.5%. The banks not looking good. Lower highs and lower lows on the banks. This is a daily chart though. But still, let's go to the weekly chart. We got extended. Technology, holding a breakout. We broke out last week. We're holding the breakout this week. I've been of the mind that what they're going to do is if they do rally into that last week of the year, they're going to take the semis up. So let's validate that by taking a look at the semiconductor sector. And it's not being validated on a weekly chart. I wish I could say I was right on this. I think I could still be made right. But to get a rally doesn't mean we need to break out. All we need to do is rally a few percentage points, and that'll keep the market alive and well. Let's go daily view here. Yeah, I mean, they can rally this easily. This looks like a bull flag setup. You have in green, you have a W formation. They're building a base. I think they're breaking this out. We bought this very, very high quality semi stock the other day. Just can't catch a bid. All right. I don't see a reason to go adding more here. Software sector, down week, 3.2%. Biotechs, avoid these names. Just avoid them. RFK Jr.'s coming in. Staples, even there, buckling. Here's a daily chart. They tried to break them out yesterday, inside day today. This is a bull flag sub. This may still break out. Larry. Corn and UNG correlated the last 10 years. Check the chart. I will do so. That would be a good idea. Yes. Particularly right now, yes, they're correlated, very, very correlated. They had the peaks and values, but yeah, I agree. There's a fairly significant amount of correlation here. Agreed, Larry. Nice one. I know Larry put on, let's check out your chart of corn. Larry put on a position on corn today. I like the trade. Corn has stopped going down. And in fact, I believe it was, Larry, what do we look at? A weekly chart, right? The Bollinger Band squeeze. Yeah, so here you have it. Nice tight Bollinger Band squeeze. This could back and fill, back and fill. You can see they did a liquidity hunt right here, and then bam, they took it up higher. So corn looking very, very good. That was a daily chart. So look at this squeeze setting up here. Very, very nice. Very, very nice. We like corn. Discretionary names. I'd like to see this get up to 240, and then I'm going to short it. This is my price target up here. Let's get rid of this. It's driving me crazy. That's better. That's where I want to see it go. 240, 238, 240. Then we short the XLY. But why are we waiting? Tesla, Amazon make up a huge chunk, 30% of this ETF. Emerging markets, avoid lower highs. Rising dollar, weak emerging markets. Same deal for emerging markets with China. Avoid. Energy. This is a trade that we're looking to put on. Long energy. This is a classic contrarian trade. Why do I like it? Because it's ugly as hell. We are in a descending wedge formation, and I'm hoping, wishing, praying for them to drop it out and down the bottom of this descending wedge formation to around 89, 88. Then I'm a buyer because they're going to rip this sucker up higher, and we will be in that position. So if you're not currently a member, you want the alert when we get long, join us. 14-day free trial offer and get TrendSpider for free, silver and gold level members. And don't forget TrendSpider, 35% discount code below. You got to have it in your toolbox, folks. I use it every day. Let's talk about gold. Gold gave up a lot of real estate today. A lot of real estate. Now, I'm not going to be the least bit surprised to see gold move up higher to new all-time highs, perhaps before the first of the year. As for the mining stocks, that's a different story, especially if equities come under pressure. It's very difficult for the mining stocks to rally with the US dollar moving up higher. Very, very difficult. And we were looking really good last night. Then by the end of business today, this is a weekly chart. We're still up on the week by 2.26%. One trading day left to go, but big topping tail. We close like this, or we close lower. We're going lower here, probably back down into the mid 40s. NUGT, same deal here. Let's go to the daily chart. GDXJ, the junior miners. They broke out yesterday, annihilated today. This is a technical analytical holocaust. Very, very bad stuff. This is why I don't buy a breakout day. I buy the retest and then the follow through, right? If people got greedy yesterday and didn't want to wait for the retest, they got destroyed today, down nearly 5% in a single day for not waiting for a retest of the breakout point. It's a simple process. Rinse, wash, repeat. Let's do some chart requests. I got to get into the members area. What time we got? 6:51. I do need to log off in a timely manner tonight. Did I put the goddamn thing in the wrong area, didn't I? Sorry, guys. I continue to do that. For whatever reason, what you're looking at here is the Bull Bear forum. Actually, this is the Contrarian Trader forum. However, you have the premium Bull and Bear Banter chat room. Small fee, join up, link below. It's free to get into our feed, though. Sometimes I post in the wrong forum and nobody got the alert. So my apologies in advance. Polish Taco, I got yours. I was wondering why I didn't get any alerts. Let's see if we got any in the chat room. Scott, we already went over Nugget. I don't know if Scott is on. I'll reply to Scott. Okay. All right. Sorry, folks. I forgot to put up the chart request. Let me go to the members premium area. Maybe they're in there. Polish Taco, we will definitely get to you. Let's bring up the TrendSpider. Okay. Okay. So Polish Taco wanted AG. First Majestic Gold. Let's take these off. Okay. So First Majestic, the monthly chart here is really, really interesting in that we have a Bollinger Band squeeze setting up on a monthly time frame. Now, this we've had this before. It happened back here. It took about a year and a half for it to unfold and for us to break out. But man, when we broke out, we went from a low of $4.59 to a high of $15. So that could certainly happen again. And this is very, very tight, equally as tight as it was back here. I think that this is a buy. I may buy some for myself. I may look for a higher quality name. Let's bring up Investors Business Daily as I'm waiting for that to pop up. Weekly chart. We broke out. These are the automated trend lines. We broke out. Back here in September, consolidated, rallied, now pulling back. What are we doing? Higher low. Triangle formation. I think you can nibble here. I think you could put a position on. You're going to get back and forth volatility. I think you could put a position on here. I wouldn't get that big yet. As we begin to move up higher, buy on strength. Don't buy on weakness, buy on strength. AG, who's best of breed in this space? Best of breed, according to Investors Business Daily, is AEM. I prefer to go best of breed because good things just typically happen to best of breed names. You have an edge. EPS growth last quarter, 165%. EPS estimate change current year, 85%. Sales change last quarter, 31%. This is Pimp Mac Daddy stuff. AEM. Now let's take a look at it on a monthly chart. Let's get rid of the trend lines. That Bollinger Band squeeze is already fired off. Here, this is what you should expect to see on AG. This is exactly what I was alluding to. Now, a way to play this is Costco reported after hours. They're down fractionally. I don't know what their numbers look like. AG optionable. 40% implied volatility. You can sell premium here. So let's do this. Let's hammer it out. AEM, seasonality. A great time of year to be in the stock. It's stable. It's not huge in terms of being up 70%. This is 50 years worth of data. Let's drill down. God, 1975 is 50 years? God damn. Let's go back to 1990. Yeah, pretty good stuff here. Pretty good stuff. Seasonally favorable period of time. If you want to look at the same thing for AG, not as good, but you're not dealing with best of breed here. So I would, me personally, I know it's a much more expensive stock. I would go with the other one. What's the name of it? Agnico Eagle Mines, AEM. And the way I would trade this is because it's already run a little bit here. I would go out 43 days or so. I don't know how liquid these options are. $36 days in this case. They don't have the weeklies. You could sell the put spread, 80 put spread, currently traded at 85.21 at the close. You want to put a little bit of a hedge on that. Buy a 70 put as protection. You could bring in $1,000 if you're doing 10 contracts. And if they're put to you, you get them $5 cheaper plus the $1,000 off as well. That's the way I would trade these. I would probably sell premium here on AEM and hope it gets assigned to me. I think it looks great. AG looks good, but it hasn't broken out yet. You can stick with that as well, but that's a longer term play, and you're not going to get the alpha. You're just not going to get it. AEM, you're going to get the alpha because it's a top tier name. All right. NVIDIA for the lovely Jody. So if I'm right, and they're going to move the semis into the back half of the year to goose the market because the semis have been lagging. You got to have NVIDIA. So let's check out seasonality. Let's try that again. There we go. Let's go 26 years. A lot's changed at NVIDIA. I want to go closer. Let's do from 2010, 15 years. December's not a great month. January, not wonderful. But let's drill down further. Let's get more curious. Let's see how we finish out the year and begin the year. Boom. So you're going into a period of time that is pretty favorable. December, the final week of the year, up 64% of the time. 50-50 the first week, probably some profit taking or whatever. Then you accelerate into the back half of January. So I think that you could think about putting on a position here, both in terms of seasonality and in terms of the technicals. We're not dropping, we're consolidating. So again, I think this is another one where I would probably take a look at the IV rank. Does it make sense to sell premium here? No, it does not. It does not. I would not sell premium unless you're going to sell a covered call. I would not sell premium. I would be covered on any position I sell because you do not want to be naked with an IV percentile, an IV rank of 16%. That begins to expand. All of a sudden, a trade that's going against you magnifies really, really bad. You do not want to be on the opposite end of that trade. Now, would I buy these options? Absolutely. Options are very, very cheap here. So you could opt to put on a call spread. Would we do it now? Let's bring up our Stokes. Let's see what momentum is doing. Stokes are looking interesting here. Stokes are putting in a higher low. Price action. We're up today. Market down, NVIDIA up. How is volume? Let's get curious. Volume is light. I like NVIDIA. I like it. I think they're going to rally it into the new year. You're welcome, Jody. Yeah, Talon, that's a good question. Thanks, Sean. Where have you been? It gets so quiet. Oh, thank you, Jody. Appreciate that. My fair skin, I blush really, really easily. Thank you very much. All right, all. Thank you for being here. We're a little bit over. If you're checking out for the holidays, have an awesome Christmas, happy Hanukkah, Kwanzaa, Festivus, whatever you celebrate. I don't care. Have a great time with the family, and have a profitable trading day tomorrow. Have an awesome weekend. Like, subscribe. Don't forget TrendSpider and a 14-day free trial offer. I'll talk to you soon. Be well.